Okay, great. We're live. Hi, everyone. Good afternoon. Welcome to today's special webinar. We're diving into two exciting NFOs from Mirae Asset that aims to help investors navigate market uncertainty with smarter, data-based strategies. So we're joined by Mr. Siddharth Srivastava, who leads passive investment product strategy at Mirae Asset Investment Managers with over 13 years of experience across NSE indices and MSCI. Siddharth brings deep domain expertise in smart beta global indices and ETF based investing. At Mirae Asset, he currently manages innovative passive products like the S&P 500 Top 50 ETF, NYSE FANG Plus ETF, Hang Seng Tech ETF, and multiple global tech focused FOFs. So over to you, Siddharth. The forum's yours before we start off with, our questions.
First of all, thank you for having me on this podcast. Happy to be here and looking forward to talk about two very interesting NFOs which we are coming.
Okay. So I'll start off with my questions. Let's start broad, right? Why are these two FOFs being launched now, right? What investor problems are they really solving in today's market?
Actually, we have been thinking of launching these two products since quite a while because they are products. They solve two very different confusions when it comes to investing. One is when gold, when silver, how much gold, how much silver on the precious metal side, and on the factor side, which factor at what time and when to shift from one factor to another. So these two are very important when it comes to precious metal, comes to beta investing, and these two products handle questions, the problem fairly well. And why now? Because first we got the approval from SEBI. Now the guidelines to launch these solution products came very recently. So that was one reason of to be honest. And second is there's never a wrong time to launch a solution products because they serve the purpose of, like I mentioned, allocation in multiple assets.
Okay, so to get this right for our viewers, there is gold and silver passive FOF and there's multi-factor passive FOF, right? Okay. Okay. So with the gold and silver FOF, why, pair these two metals together? I mean, what's the logic behind blending an anchor asset like gold with a cyclical one like silver?
It's a great question. First of all, there is in a misconception that since both are precious metals, both tend to behave in a similar manner. Whereas the whereas like at historical data, they have behaved very differently at times, and they are influenced by a set of factors. For example, gold is typically a safe haven asset. It is influenced by issues like geopolitical risk, any significant equity market risk, also higher inflation, dollar index. Uh, Typically, people latch on to gold, seeing risk anywhere else, and that typically propels gold prices. And recently, we have seen a lot of central bank also helping gold run it has. Silver, on the other hand, is a bit more cyclical. It is more it drawdowns, has more potential in terms of giving higher returns. So, people who are looking for, let's say, lesser option, looking for a method which reduces risk, should first look at gold, right? People who are looking for a more potential opportunity in terms of something giving high returns, and looking for positive news, can also start looking at silver. So that is first thing, right? That when it comes to asset allocation, having an issue of allocating assets in two or more asset classes or securities slash commodities start making sense when they behave in a bit different manner, right? So that you have an opportunity to tilt towards in certain market regimes and tilt towards another in different market regimes, right?
Yeah.
And the second is obviously because gold and silver have become so popular recently. Gold ETFs are now, from a price point of view, more than 64,000 crores. Silver ETF more than 20,000 crores. One question which we get a lot is which commodity to pick, how much to allocate in gold or silver, when to shift from gold and silver and vice versa. And I think this fund of fund, like I mentioned, solves that issue. And also, when you do it by yourself, it creates a tax incidence. For example, if you have gold ETFs right now, you want to increase your allocation to silver, you will sell off gold ETFs. You will typically buy silver ETFs. Selling of gold ETFs may invoke a STCG or an LTCG, right? Whereas fund of fund, when it does that by itself, does not result in a tax incidence. So it's probably a bit more efficient in terms of doing these rebalancing. So I think gold, silver, passive FOF, that makes a lot of sense right now.
Yeah. Fair. So you have mentioned that gold works well in, macro risk regimes while silver thrives in manufacturing cycles, right? How do you think this fund manages that divergence in behavior?
That's a great question again. So we look at multiple things. For example, we look at short term and medium term gold silver ratio, trying to identify which commodity is more overvalued with respect to the commodity. We look at near term and short momentum. We look at geopolitical risk. We look at obviously interest rate expectations, dollar index, supply and demand, especially how central banks are buying, how silver outlook is in terms of industrial consumptions, and then take a call towards which metal the allocation should shift to. So when we start, we will be unbiased in nature. So suppose, let's say everything is perfect. Outlook is same, expectations are same, technical fundamentals are pointing to both of them in an equal manner. Our allocation will be 50-50. But let's say if I'm more bullish on silver because of XYZ points, the allocation towards silver can be 65-70%, let's say. If 1 year down the line I'm more bullish on gold, let's say geopolitical issues again spike up, etc., then my fund will then start shifting towards gold when it's have 65, 70, 75% of gold. So that is how we look at both gold and silver in a very unbiased manner, having a dynamic allocation.
Okay. Okay, so when we talk about, timing these precious metals, it's notoriously difficult, right? How does the FOF avoid, regret risk for investors?
Yeah, I think that is why sorts of uh, professionally managed fund of fund is required, which will, like I mentioned, look at all those factors to take calls on gold and silver. And like I mentioned, that will not look at just one factor, which is how well a particular commodity is doing. Looking at 50 DMA or a 200 DMA, we'll look at both technical as well as fundamental factors before taking sorts of a call which segment towards tilt to and by how much to tilt to. So In terms of volatility, if you compare, like I mentioned, that gold is typically less volatile than silver. So from a volatility point of view, this fund will somewhere lie in between. Whereas from a returns point of view, also it will somewhere lie in between, and will try to generate hopefully 1 2 or percent alpha over and above a 50-50 split of gold and silver. So that's how this fund will behave from a risk and return point of view.
Okay. Okay, so on the multi-factor FOF, right? What exactly is smart beta? Can you explain? And how does this particular fund differentiate itself from, the other traditional index funds?
Yeah, that's a good question for first understanding the smart beta concept. So we all know about global indexes like Nifty 50 and Sensex, right? What happens there is top 50 companies or top 30 companies in global Sensex are picked based on free float market cap. And they are also based on free float market cap. And that is why you see HGFC being the largest company, then Reliance, etc. And that's how basically that index then trades your top 50, top 30 companies respectively on how they are performing. Now, smart beta basically or factor investing, instead of picking companies based on size, they try to pick companies based on a certain factor or a certain parameter in order to target a certain behavior. For example, we can pick up companies based on momentum factor. If you like high returns and are okay with higher risk, you will say Nifty 50 is very boring and Sensex is very boring. I want stocks which are doing well. So you are looking at momentum investing. So in momentum index and ETF and index funds, you are picking stocks which are doing well, and you're also weighing stocks based on how well they are doing. So if you look at from last 2 3 years, your momentum funds will be made up of capital goods, PSU companies, defense, etc. If you look at 2020, a lot of healthcare companies were there. 2021, a lot of IT companies were there. So whichever segment is doing well, you pick out stocks from those segments and weigh also based on how well companies are doing. Then there are other factors also like low volatility. There can be parents who say that no, I even Nifty 100 right now is risky. I want something which is less risky than Nifty 100. And you'll be like, Nifty 100 is large cap. How can I pick something which is less risky than Nifty 100? Then there comes Nifty low volatility 30, which typically picks out companies which are less volatile and more stable in nature. And in that portfolio, you'll see set of FMCG company, healthcares, large private banks, largish companies which you typically associate being less volatile and more stable. So there you are looking at not so much of higher returns, but your main focus is lower drawdowns, less risk in the long term. Similarly, I think you already and listeners already know about value. They already know about equity. So all these are factors, and once when a passive product is created, targeting these factors where stocks are based on these factors and weighted in the portfolio based on these factors, it's called smart beta product or a factor product.
Okay. Okay, which, specific factors tend to do well in bull markets, corrections, and sideways markets? How does the fund adapt to those?
So, see, whenever you deviate from a simple product,
Yeah.
you typically are inviting higher risk. and you're typically okay with that because you feel that it will result in higher returns also, right? So smart beta or factor investing also sorts of cyclical in nature. For example, again, it's very intuitive. There's no gyan here. For example, momentum investing, value investing, equal weight investing works well in the bull market. I think everyone will be aware about it, and whoever is not, just think about it. It's very straightforward, right? And something like a quality investing and low volatility investing will work when markets are choppy, when markets are correcting, because these quality and low vol typically has a lower drawdown, right? And they fall less typically, and that is why they end up performing better in bear markets and bull markets. Uh, in the long run, uh, their performance is obviously you have to compare one with another, but in India, momentum investing has worked really well in the long run. Low vol also has worked really well, but it has not generated so much of alpha. So you'll have to check it from a risk adjusted return point of view, that while it has given only 1-2% alpha in the long run, but its volatility is also lower, its risk is also lower. VF, we all know, works well in recovery market also. So post GFC, global financial crisis, post COVID, it has worked really well, but it had a long period of underperformance before that. So single factor investing, if you are looking from a long term point of view, you can look at momentum if you're okay with higher risk. If you are looking for lower risk, look at low volatility. But with respect to whenever you are looking at value momentum, you also have to be very cognizant about higher drawdowns. So I think just before looking at CAGR returns for smart beta products, I think it is very essential to look at least 15 years of calendar year returns. Then you will see how they have behaved in different market cycles.
Okay. So, factor investing, often sounds great in theory, but it sometimes can test investor patience, right? How does this multi-factor structure help, investors stay in their course?
Yeah, so basically, like I mentioned, that single factors are cyclical, right? And they at times deliver great returns, but they can have a very high drawdowns, like in case of value, equal weight, momentum, or they can have a prolonged period of underperformance also, right? So it's important to sorts of have a very patient behavior when you're investing in any single factor product. So, for example, if somebody is investing in momentum right now, I'll say that momentum is a great product for 7 years. But will you be okay with higher drawdowns? Momentum correcting more than your broad markets. So test any investor's behavior when it actually happens, right? Similarly, are you okay with low volatility if it only generates 1-2% of alpha in the bull market, right? While in bear market it can sorts of buffer your fall, but are you okay in bull market getting slightly lower returns in the long run, getting 1-2% alpha? So
Hmm.
so single factors actually test investors if they have not invested in it based on their risk profile or based on a certain goal, right? And that is where this particular fund of fund comes into picture, that this fund might invest in multiple factors and change allocation based on a given market regime. So for example, if market regime is giving positive signals about the market, valuations are lower, etc., the allocation will tilt towards your aggressive factors like value, momentum, mid small cap momentum quality, small cap momentum quality, equal weight, etc. If market sentiments are negative and valuations are on the higher side, we start shifting towards defensive factors like uh, top 15, 20 equal weight, low volatility, Nifty equal weight, etc. So it will see in which market regime we are, depending on multiple things like valuations, earning momentums, VIX. We look at both fundamental and technical indicators, and depending on that, we look what market regime it is, which factors suit that particular market regime, and we will allocate towards those particular factors and shift whenever the market regime changes, which is not so frequent. But like I mentioned, that taking making those calls, hopefully will be first able to capture the upside of most of the factors, and second avoid single factor risk by having a relatively broad portfolio compared to a any single, not any, but compared to a factor which is having most deep drawdown. So that's the trend of the product. And again, like I mentioned for gold and silver here, since allocation is being changed by the fund of fund itself, it is not resulting in a tax incidence. Had you done it by yourself, that will also result in a tax incidence. So that is an added advantage of this fund of fund.
Right. Okay. Many investors, right, worry about the overlap between factor ETFs, right? How does your portfolio construction avoid, redundancy or overexposure? How do you balance it out?
So, see, the way we look at it is that this fund of fund will invest in ETFs, right? So what we will look at is multiple ETFs which are typically created out of Nifty 500 universe. So first ETF we are looking at is Nifty 100 low vol 30. We are looking at Nifty 200 alpha 30. We'll be looking at mid and momentum quality 100, small cap momentum quality 100, Nifty 50 equal weight. We'll be also looking at one value ETF and one top 20 top slash top 20 ETF, etc. So there are multiple ETFs which you are looking at to take position in factors, and the allocation will depend on market regime, like I mentioned. So we are not so bothered about which stocks we are covering. We are more bothered about how well we are capturing certain factors in a rightful manner. So, for example, if there is Nifty 100 low vol 30, which has overlap with Nifty 50 equal weight, I'm not bothered about it because my calls are based on factors in this particular fund, and not so much on stocks. Anyways, because these most of these ETFs are fairly diversified in terms of underlying stocks, the way they are weighted. Even if I look at the final stock allocation, it will be fairly diversified.
Okay. So now coming to tax, right? Can you explain how the FOF structure helps, preserve post-tax returns compared to managing factor or, metal ETFs individually?
Yeah. So, for example, uh, let's talk about gold and silver first because I think that's a very simple example. You had invested in gold. Well, let's say you invested in gold uh, September last year, and right now you start like, right, and you say that let me move my, and you invested 1 lakh rupees in gold. You got good returns. Say now I need to shift towards silver. Let's say 50-50 allocation. So you will shift half your investment in gold ETF to silver, right? And that will result in what? That will invoke STC on your gold redemption, right? So there will be tax incidence on whatever amount you have redeemed from gold, right? And then you will invest in silver. Whereas in case of fund of fund, when similar example, if we will sell gold ETF, there'll be no tax levied on the fund of fund itself. So if I'm selling X amount, there's no tax deduction, and I'm investing entire amount into silver, where you have some tax incidence, and you'll be investing only X minus in a tax incidence will occur. So you'll have to pay that tax uh, at the end of the financial year. So those tax incidences eventually will reduce your wealth relative returns, right? Whereas in case of fund of fund, that will not happen. It will only trigger when you are exiting from the fund of fund. If you would have made money, then the STCG and LTCG uh, uh, thing will happen. Where in
Okay.
case of same thing will happen in case of multi-factor also, that you can buy and sell factors, but at the end of financial year you have to pay that STCG, LTCG, etc. And and in case of fund of fund, we don't have to worry about that. Just one clarification that when you are finally or whenever you are redeeming that FOF, which is gold and silver passive allocator, passive fund of fund, and multi-factor passive fund of fund, at that point in time, the taxation will be there. So it is not a tax-free vehicle. I'm just talking about rebalancing, which is happening within the scheme.
Okay. Okay, so what kind of investor is each, FOF meant for? Could you break down who should consider gold, silver, and who is better suited for multi-factor uh, exposure?
Yeah. So, uh, gold and silver is suited for anyone who is looking for participation in both the commodities, right? So, there will be some people who are very risk averse. For them, probably only gold is suitable. So, for them, gold and silver fund of fund is not suitable. But anyone who would want to participate in both gold and silver, I think this particular fund of fund will make a lot of sense, where asset allocation is dynamic in nature, right? And in typically in an investor's portfolio, they will hold these two precious metals, uh, let's say around 9 to 10%, right? How much which to own will also depend on one's risk profile, right? As I mentioned, gold is less volatile, silver is more volatile, etc. Multi-factor passive FOF can form part of any investor's core portfolio also, I believe. Here we are investing into multiple factors, so the factor risk is mitigated. We are going to participate in return potential of most of the factors which are available, and hopefully, like I mentioned, that drawdowns will be say uh, somewhat managed compared to single factor exposure, especially in case of versus the aggressive factors. This can form part of investors' core portfolio, and from a long-term point of view. So, if you are tactical investments in SMIA, I think standalone factor still makes lots, because there you can play cyclicality. There you can play invest based on current market conditions and uh, take an entry and exit call. But if you're looking for an exposure from a long term point of view in smart beta, this fund of fund will make a lot of sense.
Okay. Okay. Lastly, could you, highlight some of the key details that investors, should know about these two NFOs, like minimum investments, SIP options, and exit loads and stuff like that?
So minimum investment at the time of is 5,000 rupees, and an incremental thereon. Uh, uh, Post NFO, you can invest in 1,000 rupees plus, and the SIP amount is 99 rupees and onwards.
Okay. Okay. So, Siddharth, do you have anything else to add?
Yeah, so I'll just briefly summarize both of fund. So gold and silver, like we discussed, take allocation both gold ETF, silver ETF, where the allocation will be dynamically managed depending on what outlook and expectations are from both the precious metals. So this can be sorts of looked at by any investor who is looking to take position in both gold and silver precious metals, whereas multi-factor passive FOF will invest in multiple factors and change the allocation depending on market regime. If market is very conducive to aggressive factors, allocation will shift there. If we are looking market is sorts of choppy and evaluations are elevated, it will shift towards defensive factors. The is to get best of factors, shifting their allocation depending on market regime and shifting towards factor which, let's say, are finding more flavor in the current market cycle. So this product is for someone who is looking to take exposure in smart beta factors and looking for investment from a long term point of view.
Okay, so those are all the questions I had. Thank you for adding on to, and just to conclude the webinar. Thank you so much, Siddharth, for sharing your insights and helping us understand the structure and interesting use cases of the latest passive offerings of Mirae Asset. Uh, when it comes to reducing timing stress with a gold silver blend, or accessing equity factors without picking winners, these FOFs are clearly designed to solve real investor challenges, right, in a smart and tax efficient way. So to everyone who joined us today, thank you so much for your time. We hope this session helped you discover new ways to build smarter, more resilient portfolios, right? Until next time, happy investing and always stay curious.
Done.
Yeah.
Yeah, great. Thank you so much. It was great interacting with you. Have a good day.
Thank you. Thank you so much, Siddharth. You too.
Bye.